With the US, UK, and Eurozone rate decisions having been taken this week, all coming as expected, with the Fed delivering a 25 basis point rise and both the ECB and Bank of England 50 basis points, markets took it all positively. Analysts were saying the climb on Wall Street subsequently, taking both the S&P 500 and the Nasdaq into a full bull market, was on hopes that the Fed is near peak rates. Is that the case? Well, welcome to IG's Trading the Markets podcast this week. I'm Jeremy Naylor. We're joined on the pod this week by Richard Snow, foreign exchange analyst at Daily FX. Rich, welcome. Thanks for joining us.
Thanks very much, Jeremy.
What do you make of what we've seen this week on the interest rate front?
Yeah, we really had a lot to consider. If you look at the Fed, they really had something for everyone in their statement, hawks and doves alike. We saw them mentioning that ongoing increases in the target range will be appropriate. But at the same time, the Fed's admission that inflation has eased despite somewhat remaining elevated, that was music to markets' ears and really just re-engaged this risk-seeking behavior that we've seen and propelling equity indices higher, as you've mentioned.
So what did you make of, the Fed, as I said, in the wake of that announcement, we went to recent highs on all the major benchmarks on Wall Street, all looking really, really good. That was, of course, until we saw the earnings come through from Apple, Amazon, and Alphabet. But taking that out of the equation, clearly markets seeing something good, as you said, good for doves and hawks alike. Do you think we're really near peak rates in the States?
I think we are near, and the fact that we've seen a lower tempo in the pace of the hike certainly suggests that that is the case. Jerome Powell naturally, and the Fed at large, they understood going into the meeting that any admission that inflation is headed in the right direction was likely to elicit a response that they don't necessarily want, which is what we've seen in the equity markets, where sentiment appears to be believing that, okay, we're in the clear, things are looking good, equities are looking more favorable at lower levels. This really wasn't the message that the Fed wants to send across, and they did try and provide a bit of balance in their statement and just say that, we don't have that conclusive evidence that inflation has declined. Jerome Powell particularly pointing to his dissatisfaction with core services inflation, excluding the housing component. He's yet to see satisfactory improvements there. So on the whole, yes, we're seeing encouraging information with regards to lower inflation, and that certainly speaks to the fact that we are nearing a peak. As to where that will be, we're not quite sure. Previously, the Fed, when you look at their dot plot, they looked at a rate of 5.1. So we certainly remain on par for anywhere between 5 and possibly 5.25% with the Fed funds rate.
The dollar basket on Thursday's session hit levels not seen since April last year. How do you trade what the Fed is trying to achieve here? Is it a strong dollar story from these recent lows, or are you happy continuing to go short on the dollar?
I think the dollar is susceptible to further downside moves, although we have to be cognizant of how much the dollar index has declined thus far. And we have been seeing before the Fed announcement, the dollar sort of in a period of sideways movement, somewhat congested, waiting for that impulse to then continue a move lower. So I think we just need to be cognizant of where we are in that process. As I said, longer term, I do believe that there is still a further downside to be had, but possibly an opportunity here to be a little bit more cognizant of entry levels. We perhaps want to be looking at a retracement of these lower moves, so price moving a little bit higher in the dollar. Perhaps we're seeing a bit of easing in the euro. Obviously, the euro making up the majority of the components of the dollar basket. So if we see that starting to retrace, you could then start looking at entries to go short once again.
How about some of the other currencies? When looking at the currency markets and you trade these, of course, there's always two sides to the trade. Let's take a look at the other side of that euro-dollar trade and talk about what we saw from the European Central Bank this week. It certainly seems like they're hell-bent on continuing to raise interest rates, quite rightly so, because of the elevated levels of inflation, especially the German economy. We're hearing from central bank members post that meeting that they still want to raise another 50 basis points come the March meeting, which is probably the right thing to do. But I mean, looking at this euro-dollar trade, how happy are you taking a position on the euro, or do you think this euro-dollar trade is still all about the dollar?
We've been seeing improved economic data in the eurozone. I think Lagarde mentioned resilient, on the economic front, which certainly is the case now that the gas prices appears to be avoided for now. As far as the FX pair is concerned, we have been starting to see the euro standing on its own 2 feet. Previously, a lot of that was denominated, as you mentioned, or driven, I should say, by the dollar. But the euro appears to be supported by this hawkish stance of the ECB, where it's very unlike the ECB to be as unified as they have been, and they've been conveying a clear message that inflation remains too high. We are seeing numbers drop on the headline side, but core inflation certainly way too high and not really showing any signs of coming down. So they remain motivated to hike aggressively, and that comes at a time when, looking at the dollar, the FOMC statement suggests that we're perhaps nearing a peak. So interesting to watch interest rate differentials between the two currency pairs. That, in my mind, suggests that Euro USD, we could be seeing more upside, but the two very linked, whether you're talking the dollar basket or Euro USD, we certainly would like to see more beneficial levels. That speaks to a better risk to reward trade going forward. So certainly looking for pullbacks in both markets, obviously considering how far along they are in those respective trends, looking at better entries. But I would definitely say that the euro, for me, in my view, certainly does look appealing against the dollar.
Let's substitute the euro for sterling and take a look at the sterling dollar chart in the wake of the Bank of England. 50 basis points, I said, widely expected. Big question marks about where it goes from here. Interesting enough for me yesterday, when looking through this statement from the Bank of England, that they agreed with the general consensus that the UK is going to go into recession, but they said it's likely to be shallower. Does this give them much more upside scope, do you think, to raise interest rates further at meetings further on down the road, bearing in mind that the economy perhaps maybe is slightly stronger than some had feared? Clearly, inflation remains high in the UK, which is what the Bank of England is being asked to control.
I wouldn't say it really gives them license. The Bank of England have certainly been a reluctant hiker, and I think the economic news, the communication of a shallower recession, it comes across as less bad news, but still bad news on the whole. And that's the challenge the bank has been dealing with, is that they're having to fight inflation at a time when economic growth is coming under threat. We obviously see now that they anticipate 5 quarters of a contraction down from 8, and shallower economic contraction there. But the statement really is reliant on future data. They've mentioned that we are possibly getting close to a peak, both on interest rate fronts and on inflation. They mentioned we possibly at the peak for inflation, but it's difficult to tell. So they've essentially covered all angles. They've said we're getting to a point where we could see interest rates level out, but we just don't know. And they mentioned that they're in uncharted territory. So it really is going to be more a case of what is the incoming data, and that will determine the path forward. Now, speaking of incoming data, we have UK GDP at the end of next week. That's certainly going to be a telling print, as we saw a mild contraction in the Q3 print. And if we see another contraction quarter on quarter for Q4, that would confirm the recession that the Bank of England has been anticipating.
So how do you trade sterling in the wake of the Bank of England? What we now know, what the thought processes were at the BoE and in the context of that data next week. Where do you best trade sterling against which currency?
Yeah, looking at the charts, you'd have to say the recent rise in cable, so sterling dollar, that has risen to fairly impressive levels, and we've now seen the emergence of quite a bearish move near levels of resistance around 1.23, if my memory serves me correctly. So I'd certainly be looking to fade that bullish trend that we had been seeing. Interest rate hikes from the Bank of England unusually has resulted in lower sterling moves. Typically, when we see interest rate hikes, that supports currencies. Not the case for the Bank of England. I think that speaks to the fact that we're in this cost of living crisis at the moment, and rate hikes really do strain the consumer at the end of the day. So I would be looking for lower moves on cable going forward.
Rich, we'll have to leave it there, but thank you so much indeed for joining us. We're distilling down what we've been hearing from central banks this week. That was Richard Snow from Daily FX on today's podcast.